Hi, and welcome to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. As you know, on this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. The FOMC meeting is next week, so joining me today is Vizo Financial's SVP, Chief Treasury Officer Tim Sustak, and SVP, Chief Investment Officer Scott Wood. Welcome back, Tim and Scott. Thanks for being here today.
Thanks.
Thanks for having us.
All right, Scott. What economic indicators is the Fed looking at right now in preparation for next week's meeting?
Yeah, and so the Fed meets next Wednesday. I'm not sure that they're looking at a whole lot between now and then because there's been a lot of data that's come in that they have looked at. But we do have a couple key pieces of information coming out this week before next week's meeting. So one of those is GDP for the first quarter. So that'll be the first indication of what the first quarter GDP looks like. Right now, the markets are thinking, let me see right here, live 2.5% is kind of what the markets are. I was looking yesterday at the Atlanta Fed does a GDP now forecast. And what they do is they incorporate incoming data that feeds into GDP, and then their model kind of looks at that and they update it throughout the month and throughout the quarter. Their latest reading was 2.9% was their projection. So pretty close to what the markets are thinking. A little lower than what we saw to end the fourth quarter. We were 3.4%, I believe, was the last reading there. So we would be a little under that, but still a very strong reading. And if anybody has done if you've left your house in the last month or so, everything's packed, right? Restaurants are still packed, so consumers are spending there. Airplanes and airports are absolutely full. Tim and I were at a meeting last week down in Atlanta, flying on different airlines, flying from different locations, and both still on very full planes, like to capacity. No extra seating at all, to the point where they're asking you if you're willing to be bumped to the next flight if you're flexible. So consumers are still spending very strong. So we anticipate the GDP is still going to be attractive. And then there's some of the bills that were passed in the last couple of years for green energy and these type of things. Some of the money that initially had come out to help consumers during the pandemic is now kind of filtering over to businesses and helping with that. The CHIP Act that's going to help, hopefully, for us to create more chips in this country and things like that. So those things are going to be coming into the business side of things throughout this year more, less on the consumer side, but the consumer is still very strong. So GDP should be very good. Another big reading that we're going to be looking at is on Friday. We're going to get the PCE deflator reading, and that's kind of the Fed's preferred gauge of inflation. The expectations are right now that it's going to hold steady from last month. So the core would, 2.7, 2.8%, somewhere in that range, and then about the overall reading 2.5 to 2.6% is kind of where we think that's going to land. So the Fed's target, if you remember, is 2%. This is obviously still above target. It's still been tracking a little bit above target. So the Fed, they and the markets anticipate that not a whole lot of movement in that reading this month, which would be March data. So those are two big things that the Fed's going to keep an eye on. And of course, they're going to continue to weigh the other inflation readings that they've gotten throughout this month, as well as the jobs report that came out earlier in the month, which has still been pretty strong. We still have a relatively under 4% unemployment rate, 3.8%, holding up well. The JOLTS numbers this past reading a week or two ago were higher than expected. They actually had been trending lower, but still pretty high, but they actually jumped up last month. So the labor market has been pretty positive. So the Fed they'll consider that data, but I think all in all, employment and inflation are kind of still the key metrics for the Fed.
Okay. All right. So Tim, based on all of this, what is your prediction for next week's meeting in regards to rates?
75 basis point increase. No, in all seriousness, we're not going to see any move in rates next week from the Fed. I think that's pretty widely accepted. I'm sure you could find an outlier here or there, but there won't be any movement next week in rates. I'm not even sure. I mean, like Scott said, they'll have a few more pieces of information, but I'm not even sure how much new we'll get out of the Fed. And just with explanation, even in a press conference, Chair Powell gave a speech about a week ago and pretty much acknowledged, as Scott had said, hey, Fed keeps talking about they need greater confidence, right? That inflation's moving to the 2% goal in order to get in a position where they feel comfortable to cut rates. And we know that, markets were predicting 6 or more rate decreases at the beginning of the year, and that's since been knocked back. The previous dot plot from the Fed said 3, kind of inching closer to 2. And, Chair Powell gave his speech last week. He said, hey, we obviously, with the information that's come out, it hasn't given us any further confidence that inflation is going the way we want it to, and in fact, sends a signal that they'll need to maintain policy for longer at this level than they would have originally thought. So I think definitely not going to see a move in rates next week. The Fed is still trying to gather data and get a better feeling that inflation is moving the way they want it to move. If a number of other Fed officials have come out and kind of echoed that same sentiment, you've heard a few voices out there start talking about maybe an increase before we get a decrease. I think it's too soon to certainly say that that's on the table. But we always talk about believing the Fed and listening to the Fed, and I think this is just another exercise in that, right? Everybody tries to anticipate and figure out what they're going to do. But the Fed has continued to say and has been saying for a while that they are going to be data dependent and let the data tell them what to do. And, certainly with Chair Powell's comments last week, that's exactly what they're doing. Early anticipation was, maybe they'd be in a position to cut rates. The data hasn't shown that. The data has shown them, hey, probably need to stay at the level that we are for longer than we thought even 3 months ago, to combat inflation. So no moves. We'll just see if they have any new information for us.
All right. So Scott, that kind of leads into my next question. The last time we met, there were thoughts of potential rate cuts this year. Do you think that's still on the table? And if so, when might that occur?
Yeah, as Tim said, the Powell has come out and said that they may have to keep policy as it is for longer, meaning keeping rates at this current level. Not raising, but certainly the push to lower rates has gotten less emphatic or less necessary. So we have Powell's comments, we have the economic data. Tim talked about some of the other Fed members. Neil Kashkari was out a week or so ago. He's a president of the Minneapolis Fed. He's a non-voting member this year, but he's certainly still a powerful voice on the FOMC. And he said there's definitely an argument for no rate cuts this year. He's not necessarily saying there won't be any rate cuts this year, but he's saying there's certainly an argument for that. And there's certainly a way that the things unfold that where the Fed may not have to cut rates. So so there's two things. One is to look at the Fed. So the last meeting they had, they gave us their updated dots plot and their economic condition outlook. And the dots plot basically was really close between 2 or 3 rate cuts this year. It was basically 1 vote away from being 2 rate cuts was the median. But the median ended up being 3 rate cuts this year, but just barely. That's out the window, I think, at this point. I think Tim would probably agree that we're not going to see, it's very unlikely we're going to see 3 rate cuts this year without some serious deterioration in the economy, which the economic data is not pointing to that right now. So I would say the likelihood of 3 cuts is pretty slim. The likelihood of 2 is a little bit better, and probably 1 is really good. If I were to put odds, I would say that maybe 1 rate cut or 0 rate cuts is the more likely forecast this year. Today, obviously things change. When you look at Fed fund futures, which is the market's expectations of what they think the Fed's going to do now, at September 18th right now, they're giving basically a 100% chance that the Fed will cut 25 basis points. But they're not giving 100% chance of another rate cut after that. And that's been fluctuating between September and November meeting. The November meeting, I believe, comes the day after the election. So it would be a good opportunity if the Fed hasn't cut by then to kind of drop one really quick. If they really feel the need to do a rate cut, November would be an easy one. But I think based on everything we've seen recently and what the markets are telling us, 1 to 2 rate cuts and possibly 0 is much more likely. Three seems really unlikely, and it's going to be the next Fed meeting before we get the updated projections. So it'll be mid-June before we get to see what if the Fed's thinking has shifted on the number of rate cuts this year.
All right. Okay, Tim, what's happening with liquidity? Are we still seeing tight liquidity at credit unions?
Yeah, so I think liquidity pressures have let up a bit, which is a good thing for all of us. It's been pretty stressful over the past, year and a half or so. But I think there's a couple reasons for that. And talking in general, there are certainly some credit unions out there that still do have some liquidity strain, but overall, I would say that liquidity is in a much better position right now than it's been for some time for credit unions. And like I say, really two reasons for that. One reason is I think just credit unions have made adjustments, right? So they've, tamped down loan demand, whether that's through rising rates or tightening up credit a bit. And we've seen, loan demand drop a bit, certainly with the rising rates as well. Although, there still is demand out there if you want to make loans. I think the other thing is just time, right? We had a number of credit unions we talked to over the past year or so say, boy, if we could just get to 2024, first quarter 24, we've got some maturities coming due, in the investment portfolio or, mid-year. So I think just time has helped as well. But, the other thing and a big thing is we're in a time of year where credit unions are generally flush with liquidity. If you look at a normal liquidity cycle, right? This time of year, we all have money. So I think those two things, credit unions are in pretty decent shape right now. I think the true test will be, let's see what we look like in July, August, and September, when we typically get skinny again and see how much of this money that we have, these deposits that we have now stay. So like I say, things are looking good now, but I think, the test will be come the thin months at the end of the summer.
Okay. All right. Well, I'll be sure to ask you at that time. All right. So Scott, could you share a bit about what you're seeing in the auto and mortgage environment and how that impacts the credit unions?
Yeah, sure. So there's a few things going on in the mortgage and the auto environments, as well as other consumer debt. But, mortgage debt is by far the largest debt, percentage of debt that on balance sheets for consumers in the United States, as you would expect, right? It's the largest purchase we make and makes up by far the largest amount of debt that we carry. And a lot of us, I've heard the different percentages and numbers, but a lot of us listening on this call and just out there in general in the U.S., we have sub 5% loans, mortgage loans. A lot of us have sub 3% loans, that we took out 2 or 3 years ago when rates were lower, and people are less willing to give those rates up to move. It's an incentive to stay put. So those lower rates for people like me and others, and there's quite a few, I want to say 50%, maybe it's a little bit higher, 60% of mortgages out there are sub 3%. I mean, they're very low. So that's a group of people that are less likely to sell their home and move. Although there are, as you're talking to some people, there is a little bit of movement there. But one of the things is there's just a real big shortage of houses. So that's a big contributor to that. There's just a shortage of inventory. We're getting into that selling season for homes. So we're going to see what happens. I was walking through my neighborhood yesterday and I saw a home for sale. The first one I've seen go on the market in a few months. So a new home on the marketplace. It's pretty recent, so we'll see what happens. But one is the lack of inventory creates a bottleneck and an issue for buyers. So that pushes prices higher. And then the other thing is mortgage rates. With this recent movement in rates that we've had here as the markets have reassessed the likelihood of a Fed rate cut. And what it's done is push rates higher. Longer rates have moved up. So what that's done is it's moved the average mortgage rate higher. So 3 or 4 weeks ago, we were actually below 7% for the 30-year mortgage. Now we're above 7% for the average 30-year mortgage rate. And that's just been driven by rates in general moving higher. So that's going to also have an impact on the ability of some people to borrow for loans. There was an article yesterday I was reading just talking about the difference between wealthy and the expensive homes versus low, what they consider the average homes, which are in that 350 to 450 range versus, over $1 million. The over $1 million houses, prices are going up, sales are increasing. So and there's a lot of these are all cash deals. So the folks that have excess cash, mortgage rates are less important to them. It's not really as big of an issue. Either they have the cash to pay cash for the home, or they know that they're going to be able to refinance, and they have the excess capacity to handle that for a while. It's more impactful for the average American, those that are not in the top 5%, basically. So those people is more of a struggle. Higher mortgage rates means lower activity there for a while. Again, we're in we're starting the season now where we normally see sales increase. So they will increase, but they're probably going to be below what we would anticipate as a normal environment. The other part of housing is we're starting to see delinquencies pick up a little bit, which is interesting because of all the lower mortgage rates. Still nothing concerning yet, but certainly something that we're starting to see a little bit of an increase on. Where we've really seen bigger increases on the credit side has been auto loans. We're getting to the point where in a lot of cases we're either at or are starting to get above pre-pandemic default and delinquency levels. Really, delinquencies are starting to pick up and then defaults will follow. So those are getting a little more troubling. I've talked to some credit unions and they're definitely seeing those trends where auto loans are starting to look kind of ugly right now, where they're starting to see people being late and having to write off the loans. And repo the vehicles. Talking to some credit unions, they've actually had people voluntarily turn in their car keys because they know they can't make those payments anymore, and they want to try to make it as good as they can. So they're dropping those keys off at the credit union and just saying, hey, I just can't make the payment anymore. And we talk a lot about inflation, but that's a big part of it. A lot of these cars were purchased during the pandemic were bought at inflated prices because of lack of inventory and also at higher interest rates, 8, 9, 10, 12, and double-digit interest rates. So those things are all having an impact. So people are still borrowing and still looking, but if you go by a car dealership today, you'll see the inventories are way up. There's a lot more cars on the lots. CarMax is the same thing. CarMax had a rough last quarter on selling used vehicles. So there's a lot of potential issues really in the auto sector is where we're starting to see it with late payments, people buying fewer vehicles. The average car price, I think last year was almost $49,000 for a new vehicle. So cars have gotten to the unaffordability range, and I think people are just kind of backing off a little bit now too, and even those that can make the payments.
All right. Thank you, Scott. Tim, what else would you like to share with our credit union audience today, regarding the current environment?
Yeah, I think for me, working on the liquidity side, I would just say don't get overconfident at this point with what you have. Like I say, credit unions are probably, majority of them are in better shape. They've been liquidity wise in some time, and I would just say, listen to what Scott has talked about. Employment picture still looks good. Consumer spending is still good. So they've got it. They may just very well spend it. So make sure you're still staying a bit judicious with that. I know we've seen, activity pick up for credit unions investing some funds, and that's good. Certainly credit unions know their membership better than we do. So if you feel like you have some and you want to put some out there to boost earnings a little bit, that's awesome. I would just say, make sure that you've built the liquidity stores back up to where you're feeling comfortable, so we don't get caught in the same position we were in over the past year. That was a pretty violent swing in rates, and a lot of things kind of worked together there, with the COVID money and everything rolling out. So there's a lot of things that were there that, aren't really in play anymore. But I think still we want to remain a bit cautious and make sure we do have our liquidity stores built back up for the summer months. So I think that's what I would advise. And if you find yourself running into liquidity issues, certainly reach out to us. The sooner the better. We're here to help you. And, we'll help you work through any liquidity problems that you have.
Great. Scott, any final thoughts for our listeners today?
Yeah, I think I'll echo what Tim said there is keep an eye on liquidity. We've certainly seen an improvement in credit union liquidities overall. But, as you talk to different credit unions, it's a tale of different credit unions. Literally, there's some that are still very tight and they'll have to be a little more cautious and judicial and credit. where there's other credit unions that are in a pretty good position now and they're doing what Tim said, they're investing and they're taking advantage of some of these higher yields out there. So certainly if you have liquidity, it's a great time to be investing. I would echo Tim's caution is just be aware of liquidity. Remember where we came from and where we're at. Things could change, but the trend has been positive here recently in the last handful of months for what we're seeing on balance sheet, which is a reflection of what credit unions have. The other thing I would say is just continue to listen to the Fed. They haven't led us wrong throughout this entire cycle. They've been very transparent. This is probably the most transparent Fed we've seen in the history of the Fed. There are times I think they give us too much information. It's like dial it back a little bit and leave a little bit of guesswork here, but they try to be very transparent. But I think that's one of Powell's really big mantras is to kind of share what he can with the markets, and they've led us in the right direction. I don't think there's going to be a whole lot coming out of this meeting next week, but the June meeting, we certainly will have a lot more data and listen to the comments of Fed members. As Tim pointed out, some of the folks that have talked over the last little while, they're in a quiet period for a little bit before and after the meetings. But once they can start talking again, listen to what they have to say between this meeting and the mid-June meeting to get a feel if are we going to see a change in the outlook? I think we will see a change in the outlook just based on all the data that we've seen thus far. As we get deeper into the year, there's obviously fewer meetings for them to do anything with rates. So that means they would have to be a lot quicker with these rate cuts if they do them. So just pay attention to what the Fed has to say. Obviously look at the data too, but the Fed has led us right so far, and I don't think that's going to change anytime soon.
All right. Scott, Tim, thank you so much for joining me today. Really appreciate you just taking the time out and sharing your insight with our listeners. All right. This episode of Financial Minds Meet the Experts is brought to you by Vizo Financial's webinars. Want live education that comes to you? Look no farther. Vizo Financial hosts several webinars throughout the year to bring credit unions the training and education they deserve. Look for webinars to cover the fundamental components of financial institutions' operations, featuring expert speakers from our very own staff and our partner organizations. As a bonus, the majority of our webinars are free to credit unions. You can also earn CPE credits, and they are recorded for playback. Webinars for the win. For more information, go to our website at www.vfccu.org. As always, thanks for listening and make it a great day.